Welcome. My name is Van Richards. I'm a chartered financial consultant, and I come to you every day to talk to you about stocks. And I talk to you about stocks as to how that you could use a particular stock and identify a stock that you can use to accumulate wealth for your retirement, for whatever future thing that you have in mind from that standpoint. And we look at stocks from three different aspects. Number one is we're going to look at stocks' earnings. We want to make sure that they have a good, strong earnings history if they're going to be able to fit into your portfolio. The second thing is we're going to look at their competitiveness. How do they match up against companies that are doing something similar to them? And then number three, what's their stability? What's their future look like? And if you can identify those three different aspects of stocks, then you're on the road to identifying stocks that will help you create a strategy where you can have a retirement one day that you'll never run out of money. You can do that. I know that you can. So without further delay, let's get right into talking about the NASDAQ stock analysis. The stock that we're going to discuss today is Zoom. Zoom is it's an amazing company, and it's become part of our language actually now. When you talk to someone and you say, hey, let's just Zoom, or I have to go to a Zoom or something like that, it's become part of our language. It's like phone. Could you ever think of calling someone on an electronic device and say, I need to phone you, or, hey, give me the phone, whatever that standpoint is. And the idea is it's become part of our language. It's become part of our country. And in a very short period of time, it may seem like that it has been around for a long time, but Zoom itself only became a public company in 2019, April of 2019, $62. We're going to talk about where that went today. They have an interesting track that they're going to be running on. So let's get right into talking about that. All right. The first thing that I prepared for you to identify is just to tell you a little bit about what the company does. Now, I know that you know what Zoom is. If you've been around for a day, you've heard about it, but they've got a little bit more to it than maybe what you're familiar with. So watch this with me if you would.
Don't be shy, 'cause I think you're beautiful, and I won't let you forget it. Don't be late, but I will wait, and life won't bring you down too far, 'cause I just won't let it. Life won't bring you down too far.
Well, Zoom ended the day up 5.49%, and you're going to find out why it's heading upwards in just a few moments as we talk about what they're going to be going into. One thing that I do want to mention to you is, and this is actually happening tomorrow. If you're listening to this on a replay, today's the 13th of October, and tomorrow, the 14th, there's going to be Zoomtopia, the video communications financial analyst Zoomtopia. It's a live video webinar that Zoom is going to present, and you can actually listen to it if you want to. They're going to have a replay that's going to be available. I believe it's about 3 hours after the initial live event goes on. But if you're interested in it that much, you really want to go over to Zoom, you go to their website, and then you just go to investor relations, and there will be a connection on there for that. So that'll help you having a little bit more insight into it. And maybe today will be a little preface for some of you that are listening to this early. It's interesting to see what's been going on with Zoom over the past year, just the past year. Now, I mentioned before that they started out in April at about $62 a share. A year ago, they were trading at $70.80. That was on October the 14th of 2019. This is even before that we ever knew that there was going to be a coronavirus pandemic. That was when life was simple, remember? Today, this stock closed at $518.55. Now, there's some quotes I've seen that have said $518.79. We're going to go with the one that I've got right there for today. Wow. Hold on to your heart. 632.42% growth in 1 year. Yeah, okay. The red letters here, we'll remember that. The past performance is no guarantee of a future result. Now, I know some of you that are out there listening to me, you're going to type into the comments in just a minute. And I like your comments no matter where in the world that you're listening from. Somebody's going to type in there and going to say, do you think that Zoom is going to go higher? Well, I'll tell you what, listen a little bit more and you'll see what I think is going to be happening with Zoom as we go on. Now, I talk to you about dividends all the time, but look, Zoom doesn't have dividends. It's only been around for about 2 years. The video communications growth revenue of this company has been astounding. Just in the second quarter, it grew by 355% to $664 million just in the 2Q of 2020. Now, here's the other part that's very amazing about that. They only projected that their earnings were going to be 500 million, and they blew past that to get to 664 million. The growth of the large customers for this company is interesting too, because as the coronavirus pandemic forced people to do meetings at home, to do school at home, to do all kinds of things from remote locations, the large customers grew by 112% year over year. Now, when I say large customers, that's going to be the ones that's creating over $100,000 in revenue for Zoom. The small customers like me, hey, if you're one of those people out there that pays about $14 a month for your Zoom, you're considered a small customer. And small customers are actually a big deal for Zoom because they grew from 20% of their total revenue to 36% of their total revenue. Now, when we get to this part of the show, we always put up the graph and we talk about the estimated earnings and the actual earnings. And usually I have a long graph that goes back to maybe 2014. Well, I can't do that. The reason I can't do that is because the history only goes back to 2014. So we're going to look at it from this standpoint. The history in the graph that you're going to see is only going to go back to the first quarter of 2020. And we're looking at the projected earnings for the second quarter and the projected earnings, which actually they will give you more guidance perhaps tomorrow. If you listen to the Zoomtopia, perhaps they'll give you a little bit more information. Now, there's a lot of positives on Zoom going forward. One thing is that the user base and the revenues are expected to continue. They're expected to continue to grow. And you see, it has stickiness to it just a little bit. When I say stickiness, what I mean is that monthly subscription fee, it just continues. And, you know, if you're a user like myself, you just don't really pay attention to it. You just pay it because you use it regularly. Customer satisfaction for this company is very high. One of the reasons why that this company began was because the WebEx experience that was going on with their competitors like Cisco was kind of clunky. I remember a few years back first using WebEx, and you know, it was kind of like I couldn't get onto the meeting and it was very difficult to do. Nowadays with Zoom, you just click and go. Now, WebEx has gotten easier, but that was one of the reasons why, and one of the motivators, that one of the reasons, the catalyst that Zoom grew so fast, because users could use it very easily. The profitability also is much higher than software peers in itself. Now, everything's not coming up smelling roses at Zoom, though. I don't say it's going to be bad, but these are some obstacles that Zoom has going forward. Think of it. They have meetings and chat. These are the things that you saw in the video at the very beginning. Meetings and chat, video webinar. I can't talk today, can I? Conference rooms, phone systems, marketplace. The real hurdle right now for Zoom is that they are a very young company and they have a lot on the table to execute. They have a good history of it and they seem to have a very good management team in place, but they've got a lot of big challenges that are in front of them. The other thing is there's no moat for this company. Now, what do I mean by a moat? This is what I mean by a moat. The moat is that imaginary barrier that is in between the company and in between their competition. And let's talk a little bit about some of their competition as we go through this. We're going to talk a little bit more about some of the negatives because that moat has to do with competition. Competition can come in pretty easily at this point if it works out well for the competition. Now, that kind of sounds like, yeah, Captain Obvious. They have to work harder and be able to take their customers. But the point is going to be that right now, Zoom is trying to expand its webinar business, its conference room business from that standpoint for businesses. The dominant companies right now in that arena are Cisco and Microsoft. So one of the negatives is they have to be able to overcome that. And as I mentioned, they're a very new company. They've only been around since 2019. And what I want you to do is I want you to look at all the companies that are out there that they have to compete with. Now, we call this the telecom service cloud business. And let's take a look at this. Actually, there's an index which has been created that's called the Unified Communications as a Service Market, UCASS. It's actually the telecom business. There's companies out there like AT&T, Adobe, Cisco, Google, IBM, Microsoft, and those are the big ones that are profitable right now. There's a lot of other companies out there that could be up and coming that we just don't know about, or else they're not worth mentioning at this point because they're not making a lot of money and not making a lot of progress. But every company that's listed here, from AT&T to Microsoft, are all substantial companies. Now, when you look at all those companies that are listed in red and you look at Zoom, what's the biggest difference that you think there is in between those companies? All the companies that are in the red have been around for a very long time. They have an established sales force. They have an established customer base. They have an established system. Now, sometimes that can work against a company, but this is what Zoom is up against going forward. So as I talk to you about that, I don't mean to sound completely negative, but I want to get across to you, I wrote a blog about what makes a good stock tip. A good stock tip looks at three things. It looks at the earnings, the competitiveness, and the stability. Now, we know that the earnings are doing really well for this company. We're talking about a lot of stiff competition, and the stability is kind of questionable because all these other companies could come in and basically do the same thing. So there's no moat. There's no stickiness to it right now. Now, let me show you the spaghetti graph of everything that's here. These are all the companies. Now, I'm going to show you two different graphs. And the reason I'm going to show you two different graphs is because when I show you the Zoom graph, the Zoom performance over the past year dwarfs everything else. So you can't see what's going on from a company standpoint. All these companies, and I picked the top four that compete right now with Zoom. That's Adobe, Cisco. All these companies moved okay. You have a company out there like Adobe that grew 85%. Cisco was at 61%. Google, 29%. Microsoft actually was down. Well, it wasn't Microsoft, excuse me. That's Cisco that was down 11%. I got that backwards just a little bit. Adobe was up 85%. Microsoft was up 61%. And Google is up 29%. And Cisco is down 11%. Get those in the right order from that standpoint. Now, let's look at how everything stacks up when you throw Zoom in there. Wow, it's amazing. Zoom just dwarfs the performance of all those companies. You have to remember, too, that you have a company like Adobe that was over 80%. But when you have a 632% rate of return, nothing matters. But the key there is that the past performance is not going to be a guarantee of the future results either. Now, all these are growth companies. And when I talk about growth, one thing I do have to keep beating as a drum to you every day is that if we have an increase in corporate taxes, if we go from 21% to 28%, that growth that you just saw is going to be hindered. All these companies are communication services. The Bank of America Global Research that was done back on October the 4th said that those companies will have a drop in earnings of more than 10%, more like about 15% because of corporate taxes. Okay. Now, what does Morningstar say about this? We're going to look at the different analysts and get an idea of what they're saying that may happen. You have to understand, I think that of all the research companies that are out there, Morningstar is probably one of the most thorough and one of the most conservative. What they do when they pick a fair market value of a stock is they look at that particular stock and they will take a multiple of either their earnings per share, their sales, or some actual accounting fact. They're not just picking something out of the air and going, I think that it's going to perform like this. Now, we're going to get to that in just a moment. But what Morningstar is doing is they're taking something like a multiple of EBITDA or earnings per share, and they're saying, okay, this is what we think that the fair market value is. Now, we talked about the fact that the stock is currently at $518.55. But when we look at the fair market value that Morningstar has pegged for this particular stock, it's only $153. So what Morningstar is saying is that this stock is trading at an astounding 238.92% premium. That means it's overpriced by that much. Wow. Okay. Another thing that you got to think of too, let's see if I can find it real quick. The price to earnings ratio of this stock is 667.67. And you got to think that the average stock in the S&P 500 right now, the price to earnings ratio is right around 30. So this stock is trading well over top of what its fair market value is. But that's why it's a growth stock. Could it continue? Of course, it could continue. Could it not continue? Well, we're going on that route right now. Morningstar, of course, remember their star rating for stocks is different than it is for the new mutual funds. Their star rating says that the fair market value of this being where it's at, we're only going to give it 1 star. So now, this is something that just came out on last Friday. Today's Tuesday, so it's only been out for a few days. Now, you saw today that the stock was up about 5% of where it was. On Friday, Muzo Securities came out and said that they were going to issue a buy rating on this particular stock. And anytime that an analyst comes out, one that is of merit like Muzo Securities, when they come out and they say that we're going to put a buy rating on this, a lot of people jump into it sometimes. If you're one of the lucky ones that can get into it real fast, then you might be able to make a profit off of it. It just depends. If you go over to that blog that I told you about a little bit earlier on my website, go to richardsfinancialplanning.com, or actually look in the notes to this video. If you're listening on Twitter, go over to my website at richardsfinancialplanning.com, all the way down to the bottom, the junk drawer where it says blog, and click on that. And there's a great blog that I recently wrote. And what I highlighted was some of the things that were going on with Xilinx and AMD between the proposed merger between those two companies. Now, when we talk about stock tips, if you're lucky enough to get into a stock when the analyst issues a buy rating, then you might make a profit. There perhaps is a little bit more potential going forward based on the numbers that came out from this analyst. But what this analyst said on Friday with the market value of it about $492 is he pegged the fair market value, or else what he was saying the value of the stock, as $550. Now today it closed at $518. So based on their buy rating, there's still some room to grow from that standpoint. So we just have to see how things are going to work out. Let's take a look at what the average analyst said. Let me make this just a little bit bigger for you so that you can get an idea of how it's working. With 22 analysts that have been polled for Zoom video communications, 11 of them are saying, yes, this is a strong buy. 2 of them are saying it's a moderate buy. 8 of them are saying that it's a hold. And 1 is saying that it's going to be a strong sell. So when you average those numbers out, this is what it comes out to be. It comes out to be a moderate buy, not a strong buy, but a moderate buy. So that kind of gives you an idea of what how you can look at this particular stock and going forward. Now, what I want to do is I want to kind of give you a little bit of an idea. Let me make the screen, just remove this just for a minute and talk to you for a second about the different stocks. When you're looking at a stock like this, the idea is to ask yourself, is this a stock that could fit into my portfolio? And then what you have to do is you have to ask yourself, why am I saving money for this? Now, there are those of you that get the thrill out of investing, and if that's you, that's okay. There's no problem to do that. If you're one of those people that says, I'm saving money in stocks and I'm investing because I want to retire one day, or I want to have an income when I'm 80, or I want to be able to send my children to college or something like that. Then you have to ask yourself, is this a stock that could help me for that? Like if you had retirement coming up in 5 years or 10 years or 20 years, whatever the time is going to be, or a child that's going to college in 5, 10, 15, 20 years. Is this a stock that could add to that? If it is, yes, then obviously add. If you're not sure of it, then don't from that point of view. Now, here's a good idea to consider. None of us can say for certain whether a company like Zoom is going to be immediately profitable or long-term profitable. But you can increase your possibilities for an overall profit by spreading out your investments over several different companies. Now, I'm a big fan of a concept called direct indexing, and direct indexing works like this. You go to an index like the NASDAQ 100. That's the 100 largest companies that are traded on the NASDAQ. The NASDAQ is an index that's an electronic index. It's not the one where you see the pictures of the guys with the, the bid sheet saying, up or down or whatever the case is going to be. That's more the New York Stock Exchange, and sometimes that's going to be a view of what's going on in the commodities markets. That's not what happens in NASDAQ. NASDAQ, everything is done electronically. They have a big building in New York. You've probably seen it. Actually, it's part of my video in the very beginning. But NASDAQ, they have 3,500 stocks that are listed. I identify 100 of them, which I'm not identifying them. They're just the largest 100 companies that are in the NASDAQ. Now, direct indexing is this. If you were to buy a percentage of every stock that's in that index and use that to go forward in your investing. Now, there's a concept which is called a random walk. And a random walk basically says that, it doesn't matter what stocks you buy. If you have a good variety of them and you keep them for a long time, you're going to make a profit. That's kind of in a nutshell, putting it from that standpoint. If you use that strategy, it's basically direct indexing. Index funds do the same thing. If you go to an index fund, but they're going to charge you a management fee. The same thing as if you use an ETF, an exchange traded fund. Now you have to make sure that that particular security fits into your overall retirement strategy, and you're comfortable with the risk that's associated with it, and you're comfortable with, you understand the fees that are associated with it too. And if you're okay with all those different things, then that's how to use that particular type of investment. With a direct index, what you're doing is you're buying a percentage of every last one of those stocks. And what you need to do is you need to be able to say, if you want to do a direct replication of the index, you would base it on the price of the company that's in the index. In other words, let's say, for example, if you were going to do the NASDAQ 100, of course, the company that you would have the highest weighted is going to be the most valuable company, which is going to be Apple. Now, if you say, I don't want as much Apple in there because I think that there might be some risk on it. Oh, by the way, did y'all watch the unveiling today of the 5G phones? That was kind of interesting. We'll see how that goes and all those different models that they have coming out. But to digress no more, I want to get across the concept that if you're using direct indexing, you're using the same percentage as the value of the stocks that are in the index. If you don't like that allocation, then you can change it around. Direct indexing allows you to do that. Direct indexing also allows you so that if you don't have $300,000 or $400,000, which it would really take to buy at least one share representative of every stock that's in the NASDAQ 100, you can buy slices or parts of it. There's companies like Fidelity and Schwab and TD Ameritrade and a lot of those other different companies that will let you buy fractional shares. I use a company called Folio that does the same thing. It allows clients to buy proportionately what they need. You could take $100 and invest it in the NASDAQ 100 and have a microcosm, a small portion of each stock represented. Doesn't matter whether it's going to be an expensive stock like a Tesla or a Google or a cheaper stock that's out there. Most of the NASDAQ 100, none of them are, I believe, probably the lowest price stock is going to be maybe $5 or $6 a share. There are those, of course, like, those that will go over 1,000 also, like the Amazons and the used to be Apple and Tesla, but they've split. So anyhow, I digress. Okay. So the idea is this is how you use those particular indexes. And if you want to use an index for direct indexing, one of the best guides that I can recommend to you is actually on my website. If you go over to richardsfinancialplanning.com and you go all the way down to the bottom and you look at the blog will have an entry on direct indexing, and that'll give you a little bit more information in there too. So hopefully that gives you some help. If you need further help, go over to my website, which is this at richardsfinancialplanning.com, and you can schedule a call to learn more. Now, I only open this up to people who are residents of the state of Texas because that's where I do business. If you're anywhere in the world, of course, you're welcome to the information that I share with you every day here, but I can only do direct consultations with people that are located in Texas. So if you go over there, you can sign up at the schedule a call to learn more button, and we can work it from there. So thank you for taking the time to listen today. I hope that you had a really good day, and I hope that you have a good day tomorrow. Come back again tomorrow at 5 o'clock, and we'll cover another stock and talk about the earnings, profitability, and the competitiveness of those particular companies. Have a great evening, everyone.